We detected an unusual trade worth $12.5 million on AT&T stock, ticker symbol T. But here's what makes this even more interesting. AT&T reports earnings in less than a month on July 23rd. And so in this video, we'll break down this unusual options activity to find out whether this wealthy investor is going bullish and buying, expecting the stock to move higher, or bearish and selling, expecting it to drop lower. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, including potential access to earnings data before it's public, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. Now, as we can see here on the chart, the stock is trading near its 52-week high. So the big question is, will it break out to new highs or drop back down? According to technical analysis, this price level could act as resistance again, rejecting the price down lower, just like it did in the past. So yeah, technical analysis can be confusing, and that's why it helps to look at what smart money is doing. And so to level the playing field, let's dive into the unusual options activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, the most unusual trades happened on June 27 at 12:21 at the 40-second mark for these June 18, 2026 options at the 32 strike calls and the 25 strike puts. We can see that a quantity of 5,000 contracts were being traded. And based on our deep research and analysis of other datasets, this wealthy investor bought these 32 strike calls and sold these 25 strike puts. By selling those put options as part of a cash secured option strategy, this investor is essentially willing to own 100 shares of the stock at the $25 strike price. That means each put options contract sold required $2,500 of buying power. So, to estimate the total trade cost, we multiply this by the total number of contracts sold, 5,000, which equals $12.5 million required for this unusual trade. Now, you might be wondering, is this a long bullish trade or a short bearish trade? Well, let's break down this unusual options activity and show you exactly which sentiment and stock direction this wealthy investor is betting on. So first, let's set up their option strategy on the option chain to see how this unusual trade is structured. As we can see here, for the June 18, 2026 options, for the 25 strike puts, the 5,000 contracts being traded spiked the volume higher than the 3,000 open contracts at the open interest. That tells us these were new opening trades, not closing trades, because there weren't enough existing contracts to close out that many positions. And the same logic applies to the 32 strike calls here. There were only about 1,000 open contracts in open interest. So, based on our analysis, this wealthy investor bought these 32 strike calls and sold these 25 strike puts, setting up an option strategy which we can analyze using the risk profile graph, where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line as the share price goes down, this trade becomes more negative loss. And as the share price goes up, this trade becomes more positive, more profitable, because it's going long bullish on AT&T stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. And so this wealthy investor is clearly going long bullish on AT&T stock. But keep in mind, the earnings report is being released in less than a month. So this is a higher risk trade in comparison to the trades that we shared on our website. And so if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link to our website up here. Keep in mind that our members also get earlier access to trades like this before anyone else, even before we share it with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website where you can see in real time when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? With that said, even though this trade is higher risk, we still took it, but we used position sizing and a slightly different strategy to manage our risk. As you can see here on the options chain for the June 18, 2026 options, at the 32 strike calls, we also traded these call options and got into the same position here, marked as POS, which stands for our position, and the green color indicates a buy position. But notice that we did not sell the put options because it requires a lot more capital per contract, making it more difficult to manage risk by position sizing. And so we bought these call options for about 127 each. Keep in mind that options are priced per share and each options contract controls 100 shares of stock. So to get the full dollar value of one contract, we either multiply by 100 or simply move the decimal 2 places to the right. That means an options price of 127 equals $127 per contract. And so when we analyze our trade, you can see here on the risk profile graph, as the share price goes down, our trade becomes more negative loss. And as the share price goes up, our trade becomes more positive, profitable, because this is also a long bullish trade. We can confirm that by checking the options Greeks. This trade also has a positive delta. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $32, the stock needs to trade above $33.28 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here where you can also learn more strategies to increase your profits. Let us know in the comments. Do you think AT&T stock will move higher or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.